markets, looking at past performance data is of course helpful, but it's even more beneficial to consider a framework that looks at macroeconomic indicators influencing both demand and supply, providing insights into what the market may look like tomorrow. I'm often asked why the Liv-Ex 1000 index of fine wine, which tracks the price of 1,000 of the most sought-after wines in the world, experienced a modest decline in 2023, while at the same time the S&P 500, which tracks US stocks, went up. Well, there's several reasons for this. Number one, no asset ever goes up in a straight line. There are necessary and healthy phases of consolidation for any asset class. Fine wine has enjoyed excellent returns in the past decade. Second, it's important to acknowledge the complexity of market dynamics. While global demand for fine wine in 2023 has been more subdued, it's just one variable among many. The impact of global monetary liquidity drying up due to unprecedented interest rate hikes in any developed market has played a significant role. What is the consequence of this? Well, people are more careful with disposable income, waiting to gauge signs of economic direction, such as central bank pivots, which would be a positive, or recession indicators. This year, the Liv-Ex consolidation appears to be much more demand-driven than supply-driven. The decrease in global monetary liquidity has definitely influenced consumer behavior. Addressing the question, why did the S&P go up in 2023 while the Liv-Ex 1000 didn't? Well, the S&P is an index that represents the most liquid and actively traded stocks in the world. It's a highly efficient market, and investors price in very quickly forward-looking projections and central bank decisions. So, in 2022, the S&P went down because it was pricing in advance, the upcoming rate hikes and liquidity tightening that eventually happened in 2023. The wine market is not liquid and not efficient, and in fact, as the graph shows, it reacts with a lag to new information. So, as money supply growth decreased and even turned negative between 2022 and the end of the first quarter 2023, you can see that the Liv-Ex reacted with a lag of roughly 6 to 8 months as investors react late to monetary tightening. This explains why the S&P went down in 2022 and up in 2023, while the wine market reacted with a lag to the same information due to its relative inefficiency. What does the future hold for the Liv-Ex? As of this recording, it's likely we have already reached peak interest rates in Europe and the US zones. The jury is still out there as to when that liquidity will increase again, as the narrative higher rates for longer is prevalent. But most likely, I believe it will happen within the next 6 to 8 months. So, is now a good moment to invest, you ask? I say yes, because while it's impossible to time a market, it's likely we have hit the bottom of the consolidation at a global level, so now is a good moment to add to your portfolio. Cheers to 2024!